Hey guys, just a quick aside before we get into this podcast. This is a dry podcast and we do go through a lot of information. This is one of our longest episodes ever. Phil and I have written an ebook that goes with it. And actually the ebook came first and then we did the podcast second. So if you just basically want to skip to the things that you look interesting in this episode, it's literally me and Phil struggling to get through these tools. So bear with us. Again, this is not the most exciting, but I think it's really important that we show you how difficult it can be as well, because we're trying to navigate our way through it. Hey guys, 4 free financial planning tools if you wanted to DIY your super is what Phil and I are doing today. We're both qualified financial planners, and watch along as we try and figure out this process. Right. So what we've done is we've been talking to people a lot about their financial planning journey and where they want to come from. And for today's episode, we thought we'd try and flick it around a little bit and say, well, let's imagine we are you. You're trying to figure out what to do with your super. You might have never spoken to us before, or you might be a financial planning client of ours. But let's just imagine that let's imagine if you are a financial planning client of ours, you've sent this episode to your mum or your friend, and they're a little lost in the wilderness around, is my super fund the right thing for me? Am I on the right journey? What do we need to do to make sure that I've got the best thing for me? So Phil and I have basically just sat down, got a cup of coffee, gone through Google and Googled free financial planning super comparison tool. And we're going to try and act like just a normal person, try and navigate the process. So I've got the AMP risk profiler tool in front of me. And Phil, tell me, what have you done? What's your journey?
Yeah, well, mate, I've just had a bit of a click around and I've found my way to the Australian government superannuation comparison tool. So this is one that the government puts out that's intended for the layman to use.
Now, this is interesting because I have a personal experience with this one. And it's interesting. There's that meme around, if you hear someone being confident about something, about a thing that you know nothing about, you're like, oh, okay, that makes sense. But then if you hear someone who's being confident about something that you know a lot about, and you're like, wait a second, they're completely wrong. I saw that tool because it came up when I was trying to find a cheaper electricity deal. So I used the government electricity finder tool to try and get a better deal. And I was like, hold on a second. This is just like the super comparison thing. And I know that's absolutely hopeless. But anyway, Phil, let's do it. Let's crack into this tool. Let's see what you think.
Yeah. All right. So what do we got? So basically, okay, they're offering me a personalized version if I log into my MyGov account, which obviously I'm not going to do because you don't all need to see my personal.
So what display of the My Super products? Okay, so it's only going to show you My Super products, but we know those don't perform the best.
Nah.
This is bad to start.
90% of the available options on the market are missing before we even get in there. It's a ripper start. Anyway.
Bullet point 2, no good. All right. Can we go back into some of the rest of those bullet points, please?
Oh,
sorry.
Yeah, sorry.
What do the rest say? Welcome to the Wealth Lab podcast as 2 guys stumble through a website. Okay, we can't get backwards. All right, we're in it. Let's just go. Let's just go with it. So Phil's typed in 21.
Yep, exactly.
Age 21.
Yeah. Ignore the grey hair. Let's say, I don't know, 200 grand's a common balance we see popping through with clients. So let's have a look at that. What do we got? We've got investment performance. I can choose from performing, underperforming, or not assessed.
Why would you pick underperforming?
Or not assessed. That kind of seems like it's going to defeat the purpose. But anyway, fine.
Click all. I just want to see what happens. Yeah. Because you might have that'll be like a PSSA. That'll be the government ones. You must, the WA and the South Australian ones. Yeah. All right. It doesn't give me anything. So what do we do? Is it we just pick the one with the highest?
Saw someone's and what else? Hairstyle.
All right. So Phil, so there's a few tick boxes that you're able to basically tick. And it's got the annual fee. And the annual fees are around about 1%-ish of the balance, about maybe between 0.8 and 1% of the balance, something like that. And the 10-year investment performances all are around about 7%. Some are above it, some a little bit. There's nothing over 8 and there's nothing under 6 here in the top. Well, I mean, according to this page. Now what happens? Okay.
Let's compare and see if
compare. They don't. They've done 2 ever. They've done 2. And then one, they did a bunch of performing. And then, there was some that were underperforming. And then they did one in 22, I think. We'll come back to this one. Yeah, and then every single fund passed it. There was a 0 failure rate across 300 and something funds, which is suspicious. That's another time. That's a podcast for another time. Right. There's no benchmark here against like, I don't know, just like an index or.
Yeah, that's interesting. So we've got past 10-year net returns, past 5-year net returns, past 3-year net returns.
With no dates.
And then investment. Have a look at the investment strategy part. This is useless information if ever I saw it. So we've got single diversified, life cycle, single diversified. Basically, what that's telling me is that these funds are either investing my money in a spread of shares, property, cash, fixed interest, whatever, or they're taking a life cycle approach where it starts out with heaps of shares and property and then becomes less.
Yeah. It also there's no benchmark to like just a standard
like
fund.
Compared against. Is that literally a detailed comparison?
Is there is it like key definitions? Does that tell us something? Does it show you the dates that these performance figures are on? Because they could not. So for context, if you move the date around 1 or 2 months either side, it can dramatically change what the net return is. For example, if you're doing say end of the quarter versus the end of the financial year, that could be a 3-month difference, and that could move a fund from a plus 6% to a minus 1%, or depending on the volatility.
It's huge. And like when we're comparing funds on behalf of clients, we're clearly not using this tool because based on what I've seen so far, this is completely and utterly useless. But we've got some pretty fancy software that we pay a lot of money for.
All right.
It allows us to assess the market. And not all funds reporting dates are the same. So it can be really difficult to compare those timeframes because some may not have released data beyond the end of last financial year. So it'd be interesting to actually know what
let's click on product details. Let's see what happens. Okay, it just takes us to this fund.
This one just gives
not helpful. Phil is clicking on the link and just saying like, basically they just direct you to it's almost like a 401 URL, like where it doesn't quite work. Yeah, an old product performance on it as well.
Awesome.
Cool.
My professional opinion after seeing that is if you want to compare your super using our wonderful government's super comparison tool, good luck.
It's about as helpful as the MyGov website.
I expected it to be bad, but this has really exceeded expectations on how bad it really is.
Now this really makes you question that whole energy thing, like, because I know I've looked at the energy one and been like, oh, this is helpful, and I'm like, oh, wait a second, I know this comparison site sucks, so maybe that one also was not very helpful. All right, I'm going to go driving now, and I'm going to drive, and Phil can comment. So what I've got up in front of me here is I just Googled the AMP. I basically just Googled risk profiler. So a risk profiler is a sort of umbrella term that we use in our business to identify what types of investments you should be invested in that meets your, you could say risk tolerances, but people often misunderstand risk tolerances, but it's more like volatility. Like, can you appreciate an up or a down 20%, or can you appreciate up or down 10%? I mean, because we will put you in portfolios that will 7 out of 10 years will go up and 3 out of 10 years will go down. It's just the way the markets work. And at each year, there will be movements within that time frame, and some years will be exceedingly good, and some years it will certainly underperform. And you just got to get a sense on where you're at. The more risk in a portfolio, e.g., the more volatility, the better the performance will be over a 10-year time cycle or an investment market cycle. But it's just being confident to understand that, during, say, COVID, during, say, the GFC, or during September 11, the portfolios can really take a hit. And you're compensated because your portfolio grows more. So when we're looking at portfolios, we're using what's called a capital asset pricing model. So we've got the maths. So we'll have our tools internally that we do a math set around the optimum risk return rate. And I've just got it in front of me, just going through the CAPM. There's a fair bit of maths that goes into it. I won't go into the detail now, but it's just effectively trying to find the optimal risk and then the return for any given asset portfolio. And you can Google the efficient frontier, which is a set of optimal portfolios that offers the highest expected return for a defined level of risk, or conversely, the lowest risk for an expected return. So what we are trying to do as investment portfolio managers is to find that sufficient level of risk that it maximizes the return. And what it looks like is it's almost like a wave. And what happens is that the number of portfolios that you've got will be distributed across the amount of risk and the amount of return, and having the ultimate blend, which is as close to that expected risk-free line as possible, is where we build our portfolios. And for example, some portfolios will have way more risk than they should, and they'll even have a lower return. And those should be scoped out. And just getting back onto what Phil was saying, he was like, I've got no idea what's in these assets. You could be getting a 7 or 8% return. That's awesome. But what are you risking? Potentially, it could be something out here or out here. And trying to get as close to this portfolio as possible. Phil, let's grab a hypothetical client. Let's say, for example, I'm 50. I've got a house. I've bought and sold some shares in a while, but nothing really. And I've got my 200 grand in super. Yeah. Click start. Great. This thing is going to tell me what sort of risks I should be doing, what sort of investments I should be doing. What level of investment risk are you comfortable with? I don't know. Aren't you supposed to tell me that online tool?
Dumb question. Okay, cool.
I don't know. You're the risk profiler tool. Think about how well you accept the ups and downs. I don't know. I'm definitely not going to click high. Low. I don't want my portfolio to go up and down that much. I know. What level of investment returns are you looking for? High.
Is there anyone on the planet that's not going to go low and high?
They're linked.
Jesus. So even they're aware their question's shit. They're just going to force you to answer them how you have to.
So I can't actually have a blend. I can't have a medium to low. I kind of, all right.
I guess that's one way of getting the point across.
Well, okay. For the purpose of this, it's just forcing me to click medium. And it's also, so what level of investment returns are you looking for? Which is such a weird way on saying how much money do you want to make over the long term? What level of investment returns are you looking for? I guess, who's going to say, this is like getting back to the other thing. How much money do you want to have 10 years? Low amount or medium amount? Yeah, great. Well, it won't let me click high. Oh, medium. How important is keeping up with inflation? I don't care. Inflation's irrelevant. I should be, having an optimal portfolio. Low. Yes, no, Phil. No, we're just doing this as layman's.
That's just my point. You can't just bang that question at someone.
Jesus. All right. How long would you like to invest for? All right, 4 to 7. Let's say I'm 50. Let's say I'm 52, and let's say I want to invest for another 8 years. So let's just go. I'm 53. Okay, I'm 53, and I've got 7 years left in me. Let's go there. View my results. Hang on. Did this move? Yeah. Hang on. You didn't. Well, that was unexciting. It says I'm a balanced investor. Your investment is balanced. Yeah. What happens if I go high, moderately aggressive? It doesn't tell me. I see. This is the profiles at the bottom. So the balanced investor, a balanced portfolio typically invests in 30% defensive assets, cash. Okay, so 30% of my money should be in cash according to the AMP fund, AMP risk profiler, and 70% in shares. Oh, cool. What sort of shares? What? Only cash. 30% only in cash, and then only Australian shares because we're in the AMP.
Also, just to point out,
you're in a great. Yeah, we know that.
And all funds don't try and use that as a basis for comparison.
Absolutely. Okay, so according to that, I was a balanced investor or potentially a growth investor, but I'm a bit confused. It doesn't really answer the question on where I should be investing my money.
Yeah, I'm ready. Yep.
Do you want to push the Mercer one?
Yeah, I'll start with there. Yeah. Yep.
What was the search term you used, by the way?
Into it. Yeah.
Fancy. So there's a bunch of stuff on the screen for those listening in.
Yeah.
So for context, if you're listening, there is it's basically like age, date of birth, so age, income, your gender, your salary, your superannuation balance.
Yep.
And there's just some toggles that go left and right and up and down around retirement age. As well as it does have the age pension, which at the moment is just under 30 grand a year. It's about $28,000 a year or something like that, which will be eligible for at age 67.
Yeah. Cool. I'm already retired. No. Yes. All right. Well, no, because I'm still working. Current annual salary, I don't know, 100 grand sounds good. Current super balance, I don't know, 180. Although I'm male. Next.
Can you like change that, or is it just like a linear thing? So it's permanent.
No,
and the chart just grew up a bit. So the chart just went up a bit because Phil, this hypothetical person is now contributing a bit more. But you can't change it. So it's like a flat dollar amount up to retirement age. So you can't tier it or change it. You go hit one, see what happens.
It allows me to say maybe I'm going to go part-time or something and my salary's going to drop from 100 to 60 or whatever.
Yeah, okay. That's pretty common. Let's do that.
Yeah, so it's pretty cool. Let's say at 59, I'm going to drop back.
That's going to stuff up your retirement chart. Push it to...
That's one thing to point out, and I can only say this because I am familiar with this tool, but really this chart at the moment is entirely irrelevant because there's a whole bunch of assumptions and stuff that sit right back at the end, and until those are set, this is all meaningless.
Well, you just invented $25,000 a year, Paula.
Yeah, because I can start plugging investment assets. Just say I had a share portfolio for argument's sake. Maybe I've got 50 grand in shares kicking around.
Yeah, it doesn't give you the return profile on that. Anyway, look, let's push through it. Let's just go. Let's get to the end. Let's go.
That's
give
the
me
issue.
time.
Probably my expected.
I'll change the repayments to... Oh, does your
Yeah,
vote?
I don't know. As a layman, I've got no idea what the hell I'm selecting here. And actually, even as an advisor, when you sit in front of me, the client, until I've had a good chat with you, I've got no idea what to select here. So I don't know. Pick a number and hope for the best, I guess. You can then switch if your strategy changes between pre-retirement and retirement. Again, a cool feature, but you need to understand the inputs. And then you've got the ability to dial up and dial down your returns if you want to. You need to be able to know.
Assuming if inflation doesn't change, and then you've got
you
can't change your fees, you can't change your insurance premiums, you can't do
out of
they
all the
move
tools,
every year. I'll tell you one good thing about this chart, which is quite good to think about. And if you scroll down the bottom there, it's got the chance of living.
Yes.
So Phil's put age 44 in, and this chart estimates that Phil has a 80% chance of living till 80 and a 50% chance of living till just under 90. Now, I don't know if that's a coin flip every year. I don't know if you can call it as an 80% chance, or I don't know if that's a point from today till then. So Phil, right now, if I flip the coin, you've got an 80% chance, but tomorrow it might be different. I'm not quite sure about that one. But I think it's it's part of our considerations. And if you're, trying to click around and do some DIY tools, you really do need to consider the age that you will pass away. We're all going to do it. It's going to happen to all of us. Most of us will probably live, hopefully, into our 90s if we can get there. And at that stage, the health costs, etc., stack up pretty quickly as well. So we've got to make sure that we're considering that from the planning tool side of things.
Against that.
Yeah. All right. Well, let's leave it there because that looks a bit. Oof.
That's good.
Cool.
It's a good tool. You just need to know how to use it.
We've got one more tool. Bear in mind, we know this is a dense podcast, so thank you for bearing with us as we do this. I Googled super funds returns. So what we've done here is we've got some standardized dates. So I've jumped on the Colonial First State one, and what they've done is they've provided me with at least a consistent date of when these funds are being compared on. And there is 230 different underlying investments, which is pretty difficult to sort of wrap your head around. And I'm just showing this as an example of this is listed by date, by its alphabetical. But for example, we could go and look at, for example, there's a geared equity fund, which means it's borrowing money to invest. Oh God, it's just crashed. And what's that saying is over a 16-year time frame, it's done over a 7% time frame, it's done a 16% return. What that doesn't show you is just how crazy volatile that fund is.
Yeah.
So if you're going to basically go all on red, you really need to be comfortable with these geared long short equity funds. Conversely, these funds are not always true to label. So for example, we could have what's called like a diversified fund here or a growth fund here. The names are not really that linked to what they're saying, and they don't really make sense. So you've got a growth fund performing at 5%. I'm not really sure about that one. Or you've got an Oz equities fund here that's at a 4% return. So this is an example on our efficient frontier of a relatively high risk fund with a very low return. So that would sit about here on that chart. And this is genuinely, we do this. We have tools that do this for us. And then it's gonna show me. Yeah. So for example, this Arcadian geared fund, it's just almost entirely in the NVIDIA mega cap that's in the US, which has done a crazy return in the very short term. And as this just displays the type of bias that people tend to have when they're trying to pick winners and
really
losers. Correct. And I'm also just going to flag this. Say, for example, the difference between a conservative fund and a defensive fund, because the names don't make very sense. So if you're a low risk investor, do you want the defensive or do you want the conservative? Which one to you sounds better, Phil? Defensive sounds to me is more than the conservative. Yeah. But this defensive fund has done 2.2% per annum over the last 7 years, which has really robbed your future, because we know that the inflation numbers have been greater than these defensive funds. Your value of money has been eroded just by inflation. So this is an example of a fund that's on our efficient frontier, having quite a. It would probably sit here, something like this. So it's well and truly under. So has a low risk, but also has an extremely low return. And we're missing out on this section here. We want to be as close as possible. Ideally, we want to be up here. You want to have high expected return with low risk. This doesn't really exist. We're just trying to get ourselves as close to this point as possible. And this is this chart here just shows you the range of different funds that exist and what they actually look like. So that's just making sure the things that are true to actually label is always something difficult, because trying to actually pick the names of things does move around a fair bit. Like, is it a moderate fund, a growth fund, or how does it work? And where are we trying to get our assets? A treasury bill fund is doing better than a defensive fund. And I'm not sure if we want to be all invested in US dollars at the moment. It's 288 investments, including first state. Yeah, you could pick one if you wanted. You could, but just basically filtering by highest performance is the recipe for that fund almost always underperforming in the following years, and not being in this efficient frontier world.
Better. Cool. I know we said 4 tools, but I do have one special mention that I came across while I was Googling super comparison tools, and I just wanted to quickly show it because it does highlight a point that we spoke about earlier as well. So we can get to come up. I've been having some technical difficulties, so I'll just give it a quick try. No, it looks like it's still not coming up. But if you close your eyes and imagine that I had just opened the Finder super fund comparison tool. You've probably come across Finder before if you've been Googling best bank account or best credit card or whatever. And they have the same thing for super funds. Oh, look, I think it's just come up now. So they've got the same sort of thing for super funds.
Phil, it's on my screen, mate. Can you see my screen?
Oh, it's on your screen, right? Good.
Yeah, I've got it working for me. All right.
Beautiful. So basically, the reason I wanted to highlight this particular tool is you can see, well, first of all, it's paid advertising. So let's not just think it's comparing the entire market. It's just comparing those that are paying to be on there. But what I wanted to highlight was, if you look on the left-hand side menu, we've got a risk level there, and we can select by conservative, moderate, balanced, or high growth. So if you just want to hit balanced for me.
There's no growth in that. That's interesting. It just keeps straight to high growth.
Yeah, it is interesting. And actually, maybe that's why they've done this. Maybe moderate is your true balanced fund, and your balanced is actually your growth fund. But what I wanted to
we're life cycle funds.
Yeah, I'm just casting my eyes at a few of the funds that are on this list, and I'm not seeing any of. I'm seeing very few that are actually a true balanced fund. Most of these are growth options with a balanced label slapped on it. So
it's also only got about like there's not a lot of it's just all these are just our industry funds as well. There's no the actual underlying ones we looked at. All right, and so if we hit compare, what happens? Oh, it's the same as the government website. There's no time.
Nah.
There's no sort of feed either. And you can see the bottom. You can see in the bottom of my screen. It's got the redirect thing where they tagged. Fair enough. No. Thank you for the bonus.
Please enjoy.
All right, guys. Thank you so much for staying with us. We know that this was a big episode, but a little bit different, way less clickbaity in terms of the meaty content. But we've also written a book to accompany this podcast. Me and Phil have had a journey going through it. So we've got the digital book that will accompany this. And we understand how difficult it can be in your side of the screen trying to navigate what retirement could look like without the help. And this is not helpful. Well, as we've found, it's not that helpful when you know what you're trying to do. The benefits of having a professional advisor really help. So we do encourage you to get in touch with us. We'd love to talk further. And if you're listening to this and you're a client already, send this to a friend or family. And we're happy to get on board. All right, guys, thanks so much. See you next time.